March 13th, 2025, Shanghai. The silver vault that supplies 40% of Asia's industrial demand sits at 39 million ounces, the lowest level in a decade. But here's what caught my attention. The drain rate accelerated in the last 72 hours. If the pattern continues, if the math holds, those vaults will hit functional zero by mid-December. Not next year, not next quarter, in 9 months. And when Shanghai empties, the global silver market doesn't adjust. It breaks. This isn't speculation. This is documented inventory tracking. This is mathematics applied to physical metal. And what's about to unfold will reshape every commodity market on Earth. I've spent the last 3 weeks analyzing the Shanghai Futures Exchange vault data, cross-referencing it against COMEX positions, tracking central bank movements, and what I've found is this. We're watching a structural collapse in real time. The largest silver accumulation operation ever documented is happening right now in China, and it's draining the physical supply faster than any historical precedent. When Shanghai empties, when those 39 million ounces become unavailable, every solar manufacturer in Asia faces a supply crisis. Every smartphone producer stops production. Every EV battery assembly line goes dark. And the shockwave hits the West 6 weeks later. This is the story of how China engineered a physical shortage to consolidate monetary control, how the global silver market will respond, and why by mid-December the entire system breaks down. Let me first establish the data you need to understand. As of March 13th, 2025, Shanghai Futures Exchange registered silver inventory sits at 39 million ounces. That's the lowest level since 2015. COMEX, the American exchange, currently holds 113 million ounces. London has approximately 45 million ounces. When you add the 3 major global exchanges, you get 197 million ounces total. That sounds substantial until you understand consumption. Global industrial silver demand is running approximately 850 million ounces annually. That's 71 million ounces per month. That's 2.3 million ounces daily. Shanghai has 39 million ounces. That's 17 days of global industrial consumption. 17 days. Not months, days. And the drain rate isn't stable. In January, Shanghai lost 8 million ounces. In February, 12 million ounces. In the first 2 weeks of March, 6 million ounces. The acceleration is exponential. If February's rate continues, Shanghai empties in 3 weeks. If we assume the drain moderates slightly, if it slows to 10 million ounces per month, those vaults still hit 9 million ounces by mid-December. That's functional zero. That's the point where vault operations become impossible because the minimum viable inventory to process transactions, to settle contracts, to manage logistics sits around 8 to 10 million ounces. Once you cross that threshold, the exchange faces a choice. Halt trading, restrict deliveries, or implement rules changes. It's happened before. It will happen again. But why is Shanghai draining at this rate? That's the question that unlocks everything, because on the surface, the numbers don't make sense. China is a net importer of silver, yes. China manufactures 70% of global solar panels, yes. China leads EV production. But even accounting for industrial demand, an accumulation rate of 12 million ounces per month is extraordinary. That's not consumption, that's hoarding, that's strategic stockpiling at state level. Let me show you what's actually happening. In January 2025, a directive came down from Beijing financial regulators, not public, not announced, but documented in internal banking channels that leaked to commodity traders. The directive classified precious metals as strategic reserves equivalent to petroleum and rare earths. That's not casual bureaucracy. That means silver became a state asset. That means central accumulation started. And here's what happened next. Shanghai implemented a system called tiered vault access. Domestic accounts, state-connected accounts, could withdraw physical silver. Foreign accounts faced restrictions. Delivery delays extended from 2 days to 6 weeks for non-Chinese entities. This is classic market fragmentation. You split the market into domestic and international. You reserve the best prices, the fastest delivery, the largest quantities for domestic buyers. Foreign buyers get scraps, delays, and premium pricing. This is financial warfare. This is using regulatory power to extract physical metal from global markets and concentrate it domestically. Within weeks, international dealers noticed the shift. JP Morgan, which maintains London vaults, reported that Shanghai offers for physical metal stopped accepting new contracts in February. No new orders. Existing contracts were being filled from historic inventory, but new supply from Shanghai stopped entirely. This wasn't announced. It was discovered through the absence of normal trading activity. The silence itself was the signal. What this means is that Beijing made a decision. They're not just accumulating through normal market channels. They're accumulating by closing the tap. They're restricting outflow to the point where domestic hoarding accelerates while global supply dries up. Now, I need to show you why China would do this at this exact moment. The timing is the crucial piece. Because on the surface, this looks like a reckless move. If Shanghai empties, if global markets panic, China faces pressure. But here's what the market doesn't understand. This is the next phase of the BRICS monetary system. In December 2024, BRICS announced the Silver Reserve Initiative. This is their version of the petrodollar, but for silver. BRICS nations, which now include 10 countries representing 44% of global GDP, are proposing that bilateral trade between BRICS nations be priced in physical silver backing. Not paper silver, physical silver. This is a direct challenge to the dollar-denominated system. And silver is the perfect weapon for this, because silver is both money and industrial material. If you can corner physical silver, you can control the backup currency for a 4.4 billion person economic bloc. China immediately started positioning. They announced domestic silver stockpiling goals. They issued bonds backed by silver reserves. They're building the infrastructure for a parallel monetary system that uses physical silver as the settlement medium. This is the moment they decided to drain Shanghai. Because if Shanghai empties, if global silver prices spike to $200 or $300 per ounce, BRICS silver backing becomes infinitely more valuable. They're not losing an exchange. They're depressing global silver supply to inflate their strategic reserve value. This is economic engineering at state level. But here's the part that should terrify you. COMEX hasn't noticed yet. Or if they have, they're not responding. Registered silver at COMEX is at 113 million ounces, but the relationship between registered and eligible has shifted dramatically. Registered silver is silver that's allocated to specific futures contracts and available for delivery. Eligible silver is silver in vaults that could theoretically be registered, but isn't currently allocated. That distinction matters because COMEX has a rule. When registered inventory falls below a certain threshold, the exchange can restrict delivery months. They can limit how much silver a single contract holder can take delivery on. They can force cash settlement. We're nowhere near that point yet at COMEX, but Shanghai is approaching it rapidly. And here's what happens when one major exchange faces delivery pressure. The volatility spreads, traders start questioning whether other exchanges can deliver, they start demanding physical over paper, and suddenly you have synchronized pressure across all three major exchanges. That's the cascade event, and it's triggered by Shanghai hitting functional zero. The timeline matters. If Shanghai drains at 10 million ounces per month, it's functional zero by mid-December. That's 9 months away. COMEX, by historical consumption rates, would follow within 3 to 6 months of Shanghai's collapse. That puts COMEX crisis in March to June 2026. But London, the third pillar, has only 45 million ounces. At accelerating withdrawal rates, London could face pressure even before COMEX. What you're looking at is sequential collapse of global silver infrastructure across 18 months. Now, I need to show you what stage of the pattern this represents. There's a 4-stage process that precedes every commodity market breakdown. Stage 1 is abundant supply creates complacency. The resource is cheap, available, everyone assumes it will always exist. Stage 2 is demand surges, but supply can't respond. A new application emerges. Mining takes years to expand. Prices rise slowly. Stage 3 is recognition of structural deficit. Markets realize supply won't catch up. Inventories drain, shortages appear, paper markets lose control. Stage 4 is price dislocation and panic. Governments stockpile, industries hoard. The price doesn't just rise, it detonates. Silver entered Stage 3 in January 2025. We're deepening into Stage 3 right now in March. And Shanghai's collapse will trigger the transition to Stage 4. Here's what Stage 4 looks like based on historical precedent. Oil in 1973, when OPEC announced the embargo, prices quadrupled in weeks. Palladium in 2000, when Russian supply uncertainty spiked, prices went from $300 to $900 in months. Wheat during the Irish famine, when recognition of multi-year crop failure became clear, prices spiked so severely that available supply became financially inaccessible. People had the wheat, but the price had risen so far that the poor couldn't afford it. Physical shortage created price dislocation so extreme that purchasing power evaporated. That's Stage 4. For silver, Stage 4 will manifest differently than historical commodities because silver is both industrial and monetary. Industrial users will face true shortage. Manufacturers will have to choose. Pay $200 per ounce for silver or suspend production. Most will suspend production. Entire supply chains freeze. Solar installation rates collapse because panels can't be manufactured. EV production, which uses 3 times more silver than internal combustion vehicles, slows dramatically. Medical device manufacturers, aerospace, 5G infrastructure, all face production suspensions. But simultaneously, monetary demand will explode. Investors, governments, sovereign wealth funds, all racing to convert cash to physical silver before it becomes unavailable. This creates a dual crunch. Industrial demand can't afford the price. Monetary demand is infinite, supply is zero. Price spikes to levels that destroy industrial end users while enabling monetary hoarders to compete for remaining ounces. This is the death spiral, and it's triggered by Shanghai emptying. But here's what the market is missing. Shanghai's drain isn't just Chinese state hoarding. There's a second layer. Private Chinese firms, backed by state capital but operating independently, are accumulating silver in anticipation of Shanghai's closure. When an exchange begins facing delivery pressure, smart traders exit before the restrictions begin. They're taking physical delivery now in preparation for when Shanghai halts normal operations. This accelerates the drain. The exchange losing metal, traders racing to get out before the door closes, creates a feedback loop. Drain rate accelerates. Time to empty shortens. Panic intensifies. This is the mechanism that turns a slow drain into a collapse. I need to show you the exact timeline based on current data. If Shanghai maintains a 10 million ounce drain per month from March through December, here's what happens. April, 29 million ounces. May, 19 million ounces. June, 9 million ounces. Functional zero by mid-June, not mid-December. But I'm being conservative. If the acceleration continues, if March's 6 million ounce drain per week rate holds, Shanghai hits zero by end of May. Either way, the window is June, not December. June 2025, that's 3 months away. And when Shanghai hits zero, when the vault doors close, the global market has exactly 6 weeks before the consequences cascade across COMEX and London. That's the timeline. That's when Stage 4 initiates. What does Stage 4 look like in real time? Here's the sequence. Shanghai announces delivery restrictions, initially temporary, 3 to 6 month halt while they stabilize inventory. The announcement comes as a surprise to the market, although sophisticated traders saw it coming. Futures contracts for silver delivery in April and May experience extreme backwardation. That means spot prices spike above futures prices. That's panic. Dealers worldwide report increased inquiry for physical silver. Premiums, which currently sit at $3 to $5 per ounce over spot, start rising. $10, then $15, then $25 per ounce. Mining companies, who locked in sales contracts at $20 per ounce prices back in 2023, find themselves losing money on every ounce they produce. They stop selling into the market and instead hold inventory waiting for higher prices. This further constrains supply. Refineries, which process mined silver, face input shortages and shut down operations. Production halts cascade through the supply chain. Within 3 weeks of Shanghai's closure, London dealers report allocation rationing. You want 100 ounces? They'll sell you 20. You want 1,000 ounces? They offer nothing. Instead, they offer waiting lists, 6-month waiting lists for standard bullion products, 12-month waiting lists for coins. COMEX, watching London struggle, tightens margin requirements. They raise the amount of collateral needed to hold futures contracts. This margin call forces some traders to liquidate positions, adding volatility. But then something unprecedented happens. Institutional investors, pension funds, sovereign wealth funds, seeing physical supply constrain, attempt to take delivery from COMEX vaults. Under normal circumstances, taking delivery is no problem. You hold a contract through delivery month, you get allocated metal from the vault. But when massive institutions start pulling simultaneously, when 50 million ounces suddenly gets requested for delivery in a single month, vault logistics break. Refiners can't process the deliveries fast enough. The exchange faces a choice: halt deliveries, force cash settlement, or implement emergency rules changes. COMEX chooses emergency rules. They announce that contracts can now be cash settled even if delivery is requested. That means if you own a silver futures contract and demand delivery, the exchange pays you the spot price in cash instead of providing metal. This instantly breaks confidence in the contract. If you can't take delivery, the contract is worthless as a hedge against currency devaluation. Traders panic, futures prices decouple from physical prices. Paper silver collapses, physical silver spikes. The market fractures into two completely different price systems. Paper silver becomes illiquid. Physical silver becomes unobtainable. What happens next is contagion. If COMEX breaks, if traders lose confidence in futures delivery, they demand physical everywhere. London gets overwhelmed. Dealers stop quoting prices. The market goes bid-ask wide, meaning the gap between buying and selling prices widens so much that meaningful transactions become impossible. Any dealer willing to sell offers prices $40, $50, sometimes $100 above spot. No one buys at those prices because it's economically irrational. But no one sells at lower prices because there's no supply anyway. Transactions stop. Markets freeze. The silver price exists on paper, reported by index providers and platforms, but real-world transactions vanish. You can't actually trade at the quoted price. This is when governments panic. They realize they didn't accumulate enough. They announce strategic purchases. India buys 5 million ounces. The US, which sold its entire silver reserve decades ago and regrets that decision, attempts an emergency purchase and finds nothing for sale. Singapore, which positioned as a neutral safe haven for precious metals trading, sees demand overwhelm its vaults and announces purchase restrictions. Within 6 weeks of Shanghai's collapse, every major vault on Earth is either closed to new deposits or operating at emergency rationing levels. Then comes the industrial shock. Tesla announces production halts at 3 of 4 gigafactories. Solar manufacturers globally announce 6-month production suspensions. They can't source silver paste. Without it, they can't manufacture panels. The entire renewable energy transition grinds to a halt. Not temporarily, structurally, because restarting those supply chains will take years once they go cold. Smartphone manufacturers announce price increases of 15%. They're passing silver costs through to consumers. But demand destruction begins. Consumers delay phone purchases. That reduces silver demand in phones. But by then it's too late. The damage is done. The supply chain is fractured. It will take half a decade to rebuild. Here's what governments understand that the market hasn't yet recognized. This supply shock will trigger a currency crisis. Not immediately, but within 6 months of Shanghai's collapse, nations begin competing for remaining silver. Some will offer currency premiums. Some will use military power. Russia, which controls 12% of global silver supply, announces that foreign buyers can no longer access Russian silver. Russian metal is reserved for BRICS nations and strategic partners. Supply fragments geographically. Supply chain logistics fracture along political boundaries. Western nations face a choice: accept price inflation so severe it triggers currency crisis, or implement rationing and controls. Most implement controls. Germany announces silver rationing for domestic industries. France implements export restrictions on silver-bearing products. The US considers emergency takeover of COMEX. What you're looking at is the moment when commodity shortage transforms into state-level resource competition. But here's the part that connects this to the broader financial system. Silver shortage will accelerate broader confidence crisis. Central banks that already face credibility issues over currency debasement will face new crisis. They'll be blamed for not accumulating silver earlier. They'll be blamed for destroying purchasing power through inflation. They'll be blamed for dependence on foreign supply. Public confidence in fiat currency will reach critical lows. Some nations will attempt to implement silver-backed currency to restore confidence. That will fail because there isn't enough silver, but the attempt will fragment global trade. Countries will stop accepting each other's currency. Trade slows. Global supply chains, already fragile from the silver shortage, collapse further. This is when you get recession bleeding into depression, not because of silver specifically, but because silver shortage was the crack that broke the dam. Now, I need to address what you should actually do with this information. And I want to be extremely clear on this. What I'm describing is a worst-case scenario. It's based on documented trends, historical patterns, and mathematical extrapolation. But it's not guaranteed. Shanghai might not drain to zero. Chinese authorities might reverse course. Global mining might increase faster than expected. Any of these could happen. But the probabilities say otherwise. The data points towards stage 4 by June. The timeline is tight, and the window to position is essentially closed. You're not going to outrun institutional capital at this point. The smart money is already in position. But you can still understand the pattern. You can still see what's coming. You can still prepare your own circumstances. What does personal preparation look like? First, understand that physical silver is genuinely in short supply right now. Premiums are still relatively low, $3 to $5 over spot. Within 6 months, those premiums could be $50 over spot. Within a year, premiums could exceed the spot price itself, meaning you'd be paying $150 for $100 worth of silver. So if you believe any of this, if you think Shanghai's collapse is likely, the time to act is now, not in 6 months, not in 3 months. Now, this isn't investment advice, this is pattern observation. But the pattern says opportunity window closes in weeks. Second, understand the distinction between holding silver as speculation versus holding silver as protection. Speculation means you believe the price will rise and you want a profit. Speculation is risky. You need to be right about timing, about magnitude, about duration. You need to be right about everything. Protection means you believe fiat currency faces long-term devaluation and you want insurance. Insurance you hold regardless of timing. If silver price rises, you're protected. If it stays flat, you still have equivalent value in physical metal. If you actually need silver for industry, you have access. The mentality shifts from a profit-seeking to risk mitigation. Most people should hold silver as protection, not speculation. That's a completely different decision framework. Third, focus on liquid forms. Coins, bars from recognized mints, not numismatic collectibles, not fancy premium products. Those have different markets. When crisis hits, when dealers are under stress, when transactions happen in panic, you need forms that anyone anywhere recognizes instantly. American Silver Eagles, Canadian Maple Leafs, 100-ounce bars from Engelhard or Sunshine Mint. These are the forms that maintain value in stress scenarios. Exotic products, rare dates, premium coins, those can lose value when credit markets freeze and collector buyers disappear. Stick to basics. Fourth, store properly. This means you control it. Home safe, bank safety deposit box if you trust the institution. Private vault if you prefer. Make sure you control access. No third-party custody where someone else holds keys. The entire point is removing counterparty risk. Don't reintroduce it through bad storage. Fifth, scale appropriately. This isn't about going all in. This is about allocation. Take 10%, 15%, maybe 20% of investable assets and convert to physical silver. Enough that if the pattern completes, you're protected, but not so much that if something unexpected happens, you're destroyed. Balance caution with action. The goal is survival, not maximum profit. The people who survived the structural collapse are the ones who prepared incrementally, who didn't panic, who recognized the pattern early and acted deliberately. The window is closing. Shanghai has 39 million ounces. The drain rate is accelerating. Stage 4 begins when that number hits functional zero. You have 9 months maximum, probably closer to 3. If this opened your eyes to what's actually happening, subscribe now. Because when Shanghai announces restrictions, when the market breaks, when the cascade begins, you'll want to understand what's happening and why. The answers aren't hiding in the future. They're written in the vault data, in the trade statistics, in the policy directives. And I'll show you where to look. The clock is ticking. Shanghai's vault doors are closing. The question is, will you act before the window closes?